Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It is Monday, January 30th, and it is The Talking Point. And there are an awful lot of talking points for this week. But before I start with this week, let me just go over last week because we had really, I think, important information last week. First of all, the PCE report, Personal Consumption Expenditures Index. I love to say that. It's so tongue twister. But nonetheless, that is the Fed's preferred survey or index for inflation. It met expectations, and yes, inflation continues to work its way downward. Many people have asked me, what's the difference between that survey and the Consumer Price Index, the one that we all pay close attention to? The difference is this. The PCE actually gets its information from businesses. So just to give you an example, businesses, taking care of health care that they provide for their workers, and provide it. They don't necessarily have to pay for it, but they offer it as a benefit. All sorts of things, they go to businesses, whereas the CPI obviously comes from consumers. The other thing that's interesting about the two is that normally the PCE tends to run just a bit cooler, meaning a little bit less inflation. So I just wanted to point that out because we wonder why do we have two, and why is it the Fed's preferred survey? In addition, we had the fourth quarter first read of GDP, and that came in at 2.9%, which was above consensus estimates. Now, we could say that it indicates a resilient economy, but for those who look deep down, they say, well, wait a minute, it wasn't that great. A lot of it was inventory building. Okay, but nonetheless, when we look at overall, it was at least in the positive territory overall. I won't go into the various components for it, but overall it was. The other thing about last week is the rally. The rally was broad-based, meaning it had breadth, meaning there were more sectors. It wasn't just led by one sector, which is something you don't usually want to see. You want to see a broad group of stocks and sectors participating in the rally. And for the most part, the rally was cyclically oriented, which is what we want to see. Now, the issue is coming into February. February has a history of being negative compared with the September history, which is not very good. It's a very volatile month, the month of September. February can be volatile, and overall, statistically, it tends to just sell off a tad. And of course, we're in a period now where we're going through earnings, where we're listening to guidance. So getting back to last week, I want to point out something. I found it extremely interesting that when Microsoft's earnings came through, and the data, the actual data on revenue growth, on margins, on earnings per share came through. Actually, it was in the aftermarket, but in the aftermarket, the share prices went up. It wasn't until the chief financial officer started to speak and describe how bad December was and how their customers are simply holding back purchases. That was interesting. And by the way, that brought Microsoft down. That was the guidance. On the other side was Tesla. And when Tesla's numbers came through, the market reaction was muted, absolutely muted, until Elon Musk got on the call and spoke for a while and underpinned a rally in Tesla. So this underscores why the guidance is so crucial and why this week is going to be one of the most important weeks in the earnings season. Everyone knows this is big tech week. And the reason it's so important is they have a large weighting on the S&P 500. So we're going to see how they perform. One other thing that's noticeable from this rally or the rally we had the last number of sessions, is that the companies that announce cost-cutting measures, layoffs, generally, there was one exception that didn't hold, but generally actually do better. And the market is prepared, by the way, to forgive them a little bit and not punish them dramatically for weaker numbers. So we'll see if that holds this week, and we will, watch to see again what is the guidance. So this is an important week again for the market. It is a week where we not only have the earnings across the board in every sector, but big tech is what everyone is watching. The other is that we're going to have the Fed announcement on February 1st. Everyone expects, the futures market expects, and even Fed officials saying that they, endorse 25 basis points. So this is the Fed stepping down. But the question is, will it be a dovish step down or will it be a hawkish step down? And that depends on the statement to some degree, obviously, but also how does Chairman Powell sound in the press conference? This is always key. And normally, statistically, we have a rally when the press conference ends, but not for the last couple of Fed meetings. So we want to be very careful about how does he manage risk? Because one thing he does not want, and the Fed doesn't want, is to come out and be so dovish that the market basically looks at it and says, oh boy, game over. Maybe they won't even raise rates in March. So they don't want to do that. But again, it's a fine line. You're walking kind of a financial monetary tightrope, so to speak, and we'll see how that goes. And then on Friday, we're going to have the payroll numbers. And why is this obviously so important? It is because of the wages, that component. The Fed wants to see the wages continue to come down. It's important for them. However, and this is an important update on the Fed's view of the labor market in terms of fighting inflation. The shift comes from a number of Fed officials, not just the doves, but some of the hawks as well, saying in so many words that we don't have to, really punish the labor market by raising rates so that the economy becomes so stifled that employers have to let people go. But they believe that they can reach their goals in terms of fighting inflation without doing that. And that's a shift. However, we will be watching for a couple of things on Friday. One is the direction of wages. Remember, they were going up, and then they started to come down in the last Fed report. The other thing we're going to look at is the hours worked per week. Last report, the hours worked per week came down, and that's an important indicator because what it shows is that the economy is slowing down a bit. And we also look at other numbers regarding temp hiring, but what we are seeing is temp hiring is down a bit, and layoffs in the temp hires already there has actually picked up. So all of this gives us a picture of a labor market still fairly resilient because we expect to see unemployment still about 3.5%. But the shift in the tone from Fed officials is extremely interesting for the market. So a lot depends on how Chairman Powell presents the information and if he offers us any guidance, despite always saying he's data dependent, of where the Fed may go in March. The Fed funds futures market, by the way, has the Fed coming in with another 25 basis point rate hike in March, but then finished for the year, and even has a couple of rate cuts at the end of the year. That may change depending on the data that we get from the payroll report and any other data this week. So a lot riding on the market this week. I was just on Bloomberg Radio, and they asked, what's the most important thing in my mind for the market? And to me, it is about the earnings. It's about the earnings. It is about the guidance, because I can't stress this enough. The market wants some sense of what kind of recession we may have. And they look at the earnings, they look at the guidance, and especially the margins. How are margins holding up? Because if I have to continue paying higher wages, and if I have to continue hiring people and pay them more, oh yeah, that's still going on, no doubt about that. But at the same time, if my revenue growth comes down because of a weaker economic backdrop, then I may have to just let go of more people, and of course that adds to the recessionary fears. So all of this riding in the guidance part of the earnings calls. In addition this week, and this has to do, I think, with the currency, remember the weaker US dollar is now a tailwind for the big multinationals, and especially tech. So we'll pay attention to what Apple has to say. We'll pay attention to, all of the big names that have a global footprint. But the other thing that is important in this busy week is whether or not, if there is a rally and the rally can be continued, whether or not this market can capture, the S&P 500 can capture 4,100. That's the level, that the technicians are looking at, the technical analysts, but it gives a sense of a rally that would have fervor, that would have strength. And I would have to say that the last couple of rallies that we've had, the volume has picked up and the breadth, meaning broader participation, has been strong. And one further thing before we hang up on this call is this week the market is, by any metric, overbought. Now, overbought markets can continue to rise. Those are strong markets when they're clearly overbought and they continue to rise. But normally, particularly in this environment, you'll have something, some earnings, some statement from the Fed that actually serves as a catalyst to pull the market back and create volatility and a bit of a sell-off. So a lot riding on this week's market, all of the data, all of the earnings, and the other central banks, European Central Bank, Bank of England, right after our central bank delivers the rate hike. And obviously, if the European Central Bank comes in with a 50 basis point rate hike and has fairly strong rhetoric attached to it, the euro will become stronger, and the US dollar, by virtue of its relationship with the euro, will actually be weaker. By the way, that would be a tailwind for financial conditions globally. So have a very good week. It could be a dicey week, but it could surprise us. Nothing surprises me in these markets anymore. So this is what we're paying attention to. How do we end the week? How does the market treat the data? How does the market treat the Fed's delivery of the rate hike and the press conference? Take care. I'll be back next week. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.